Welcome to the Metal Report here. We come with new report gold moved $311 today. That is the largest single-day dollar increase since 2008. In one trading session, roughly $2 trillion shifted. That's about the entire market value of Amazon. No CEO announcement, no earnings call, no board meeting, just the oldest form of money on earth reminding everyone that it still matters. Gold is up 6% today, or $286 per ounce. Silver surged 14%. When gold, silver, and copper rise together, this isn't speculation. It's the financial system adjusting its understanding of what real money is. Jesse Livermore once said, "The market speaks before it explains itself." Smart money listens first and asks questions later. Here's what most people aren't connecting yet. Physical silver is becoming extremely difficult to obtain. Bullion recently reported that the physical market is under serious strain. Silver, in particular, is nearly impossible to source. Mints are closed. Refineries are backed up. Most competitors are completely out of stock. Bullion still has inventory because they prepared early, but premiums now reflect real-world supply conditions. They've reduced both buy and sell minimums from $20,000 to $10,000 Singapore dollars and are continuing to monitor the situation closely. Access to physical metal matters, especially during periods like this. In yesterday's video, I talked about a possible move toward the $87 to $90 zone. Why that area? At the time, silver was trading near 80, and that range represented a key overlap of technical factors. We didn't hit it yesterday, but today price reached that zone and was rejected. I won't break down all the reasons that level mattered here, because that's a full video by itself. But that's how we operate on this channel. We look at multiple outcomes using real data, no hype, no greed, no fear, just honest analysis and a clear plan. If this content is helping you, hit subscribe and leave a comment with Metal Report so I know the real community is here. About 70% of this channel consists of long-term investors, decades-long stackers. Some are shorter-term traders. That's why we often cover both perspectives, the physical market and the paper market. Different strategies, same goal. Planning, not gambling. As I'm recording this, Silver Western Spot and futures are at $85. Shanghai Spot is $100. Shanghai Futures 101 with a Shanghai premium of $15 or 18%. A few days ago, I released a video discussing a critical technical level. If price closed below the 150 exponential moving average on the hourly chart while trading above $100, we could see the early 90s as potential support. Price bounced exactly as expected. I followed that with another video discussing how the Fed chair could impact markets and potentially push silver even lower, possibly below $86. That wasn't a signal, it was a scenario, something to prepare for. And as we saw, it played out. Now here's the level everyone needs to understand. The 150 EMA on the hourly chart, which we used for the 86 and below call, is now sitting at $96. After this 18 to 20% bounce in silver from the lows, I'm hearing people call this a bottom. I don't know if it is. I don't call bottoms or tops. Nobody does. It's interesting to watch others suddenly claim insider access in front of large audiences. At that point, it becomes entertainment, not analysis. Here's what the technical data is actually telling us. A complete washout in open interest usually happens near lows. With February 26 moving into delivery and a lack of contract rolls combined with liquidations, total COMEX gold open interest dropped to 414.30, 756 contracts on Monday. That's the lowest level since June 9th, 2025. COMEX silver open interest also collapsed to 142,368 contracts, the lowest since May 20th, 2025. Open interest at multi-month lows typically signals capitulation. Weak hands flushed out, leverage longs wiped. But the 150-hour EMA at 96 is now acting as resistance instead of support. We're at 85, which is $11 below that key level and directly inside the 87 to 90 zone I mentioned earlier. We touched it and got rejected. That rejection matters. Bulls attempted to push through and couldn't hold. Sellers stepped back in. Bearish case first. The 150-hour EMA at 96 is now sloping downward and acting as resistance. When support flips to resistance, that's bearish. Price tested 87 to 90, failed, and dropped back to 85. If we can't reclaim 90 and hold, the next move could be lower, potentially retesting the 71 low. Bitcoin dropped below 74,000 for the first time since April 2025. Risk-off sentiment is spreading. The S&P 500 closed down 0.8%. The Nasdaq fell 1.5%. The Wall Street Fear and Greed Index is at 39, back in fear territory. Bond yields are rising globally. Germany's 30-year bond yield hit its highest level since 2011. The U.S. 10-year Treasury is approaching levels last seen in August 2025. Japan's 10-year is near its highest since 1999. This is systemic stress. When bond yields spike worldwide, everything sells off at first, including metals. Add geopolitical risk into the mix. Headlines reporting the US at war with Iran. If true, that's a major catalyst. But the initial reaction to war is usually sell everything, raise cash, and wait. The safe haven bid often comes later. That means more volatility before a sustained rally. Now, the bullish case. Physical silver is extremely difficult to source. Mints are closed. Refineries are backed up. Dealers are empty. Bullion Star lowered minimums from 20,000 to 10,000 just to maintain access. This isn't paper volatility. This is real-world scarcity. You can't fake closed mints or empty refineries. When physical is this tight while paper trades at 85, the disconnect is massive. Central bank gold demand remains strong. In 2025, central banks bought 328 tons of gold, just under the 345 tons purchased in 2024. Poland led with 102 tons, followed by Kazakhstan with 57 tons. Central banks have now been net buyers for 33 consecutive months. The 12-month moving average stands at 27 tons. This buying cycle hasn't slowed regardless of price. David Hunter raised his gold price target from 5,500 to 6,800, and silver from 125 to 180. That's a respected analyst raising targets while fear dominates sentiment. COMEX open interest is at multi-month lows. Forced selling is done. Historically, that's when bottoms begin forming, not always immediately, but the pressure is released. During Germany's hyperinflation from 1914 to 1923, gold rose 1 billion times. Monthly volatility ranged from 30% to 160%. Even with perfect foresight, the swings would have been brutal. That's normal behavior in precious metal bull markets during currency crises. Volatility isn't a flaw, it's part of the process. The mainstream narrative claims gold fell because a new Fed leader will keep policy independent. According to that story, gold needed to drop $200 per ounce and silver $50. That narrative doesn't hold up. Billions of people in China and India don't buy gold because of the Fed. They buy it to preserve wealth. The long-term bull thesis depends on debt, currency debasement, and physical supply and demand. None of those fundamentals have changed. The 5,600 level in gold and the $70 area in silver have historical significance. Gold bottomed near 4,400, silver near 70. Whether those levels hold long-term requires more data. Meanwhile, the Chinese yuan just hit its strongest level against the US dollar since May 2023. Dollar weakness supports higher metals prices. Pricing power is shifting east. So, what am I watching? If we reclaim 90 and hold above the 150-hour EMA at 96, that's bullish confirmation. If we fail and revisit 80 or below, more downside is likely. The 87 to 90 rejection matters, but physical scarcity and central bank demand remain overwhelming. Where does this leave us? Number one, I called 87 to 90. We hit it and got rejected. We're back at 85 with resistance at 96. Number two, physical silver is nearly impossible to source. Central banks are buying. Open interest has washed out. Number three, gold just posted its largest one-day gain since 2008. Volatility is extreme, but that's normal in currency crises. So is 71 the bottom? Or do we test lower first? That's the question. Do your own due diligence. The technical picture is mixed. Physical data is bullish. Paper data suggests volatility remains. This is war-driven price action. Headlines can change in hours. Leverage is dangerous in conditions like this. If you're a long-term stacker with a 5 to 10-year horizon, this is noise. The only real questions are availability and premium. But if you're trading or using leverage, every level matters. Know your risk. Know your plan. Never assume certainty. Invest with logic, not hype. Use your own judgment, and never follow anyone blindly.